Welcome back to the show, and today we're going into something the entire crypto market is sleepwalking through. Everyone is worried about ETF outflows, CPI numbers, liquidations, corrections, volatility, inflation, the whole lot. But behind all of that noise, there's a far bigger story building. And it's the one almost nobody is actually talking about. Bitcoin's supply shock is approaching. And the truth is, hardly anyone is ready for the magnitude of what this actually means. Supply shock isn't a phrase analysts throw around lightly. It's not a meme, it's not a hope-driven narrative, and it's not one of those hype cycles people create after looking at a bullish chart. A real supply shock is a structural imbalance. Demand increases, supply remains flat or shrinks, and suddenly the market runs out of sellers. Price doesn't rise gradually during a supply shock. It gets forced higher. It grinds upward. It breaks through resistance not because of excitement, but because there's simply no BTC available at the levels traders are trying to buy. And everything we're about to break down today points to the early stages of exactly that. Long-term holder supply at all-time highs. Miner reserves hitting depletion levels we've never seen post-halving. ETFs continuing to vacuum up BTC, even during a cooling phase. Liquidity conditions shifting globally. And the psychological piece. Fear evaporating at the same time the supply floor is rising. This isn't wishful thinking. This is math. Let's start with the simplest part of the equation. How much Bitcoin is actually liquid right now? According to Glassnode, less than 12% of all Bitcoin in existence is considered available, meaning it moves regularly, sits on exchanges, or is held by wallets that historically sell. That's the lowest amount of liquid supply since Bitcoin's inception. Back in 2017, at the peak of the bull market, the number was closer to 25%. In 2021, it was around 18%. Today, it's half of that. And that alone is enough to change how this entire cycle behaves. But the real shock isn't the percentage. It's the velocity of the decline. In the last 8 months, Bitcoin's liquid supply has dropped faster than any period outside of the early halving days. This is where analysts like Willy Woo and Dan Morehead have been sounding the alarm quietly. They've both said the same thing in different words. The market is dramatically underestimating how little Bitcoin is actually available for sale. Then we move to miners, and this is where the story becomes even more fascinating. Normally, after a halving, miner reserves decline gradually as miners adjust their operations, optimize their energy costs, scale up hardware, and wait for price appreciation to offset the reduced block reward. That's the pattern we saw in 2012, 2016, and 2020. But this halving, 2024, has broken the pattern completely. Miners didn't gradually reduce their reserves. They emptied them, hard, faster than any halving cycle before. Some analysts estimate that miners have sold more Bitcoin in the last 6 months than they sold in the year following the previous halving. Others point out something even more extreme, that many miners are now running so lean that they're sitting at reserve levels last seen almost a decade ago. This matters because miners are historically the most reliable source of sell pressure in the market. When their reserves run low, sell pressure dries up. And when sell pressure dries up at the same time demand is increasing, that's supply shock. But miners aren't the only source of dwindling supply. The ETFs, even with occasional outflows, are still absorbing more Bitcoin on average than miners are producing. People get spooked when outflows happen for a few days, but they fail to zoom out. Over a 30-day average, BlackRock, Fidelity, ARK, VanEck, and the rest are buying more Bitcoin per day than the entire global mining industry creates. Even in a week like this, with small outflows, the cumulative picture is still absorption, not selling. And beyond ETF inflows is something even more important. The fact that ETF buyers don't sell like retail sells. They don't panic sell. They don't get liquidated. They don't capitulate. They accumulate, hold, rebalance once a quarter, and buy more whenever their model tells them Bitcoin is undervalued relative to other risk assets. That's why ETF-driven supply shocks look different from halving-driven supply shocks. They're slower but much more powerful, because they come from the deepest pools of money. Now let's talk about long-term holders. This is one of the strongest structural components of the coming supply shock, And it's something Glassnode co-founder Yann Allemann commented on recently. Long-term holders, wallets that have held Bitcoin for more than 155 days, now control the largest amount of Bitcoin ever recorded. And more importantly, they're not selling. Even during last week's dip, long-term holder distribution remained one of the smallest on-chain events of the last 2 years. They simply didn't react. That's rare. Long-term holders usually start to distribute during fear-driven retracements. That's part of what makes bottoms form. But this time the behavior is reversed. They're holding. Meanwhile, short-term holders, traders, leveraged longs, impatient buyers, got wiped out. This is one of the clearest early signals of accumulation behavior. The final piece of this first section is the psychological shift we're seeing. Last week was one of the most fear-driven weeks we've had in months. Liquidations everywhere. Panic posts. Analysts predicting retracements back into the low 70s. And despite all of that, Bitcoin didn't break down, the floor didn't collapse, and fear evaporated almost instantly. That doesn't happen in a weak market. That happens when buyers are sitting in the dark, absorbing everything the market throws at them. And when you combine all of that, miner selling exhaustion, ETF absorption, long-term holders locking up supply, panic selling already flushed, and the amount of Bitcoin actually available dropping to historic lows, you're looking at the ingredients of a supply shock waiting to ignite. If you really want to understand how close we are to a genuine supply shock, you have to look at the behavior of the people who never chase hype. Institutional analysts. They tend to be conservative by nature, always leaning toward caution, always downplaying upside potential. But even they are beginning to signal concern about how tight Bitcoin's supply has become. One of the clearest examples came this week from Julio Moreno, head of research at CryptoQuant. He pointed out that exchange reserves, meaning BTC held on exchanges available for immediate trading, have fallen to their lowest point since 2018. Not only that, but the rate at which reserves are declining is now accelerating. According to his data, exchanges are losing roughly 30,000 BTC per month to cold storage, ETFs, long-term holders, and custodial solutions. When you average out miner production post-halving, the math becomes ridiculous. For every 1 Bitcoin mined, somewhere between 4 and 7 Bitcoin leaves exchange liquidity. That imbalance simply cannot last forever. And here's what makes this even more extraordinary. This is happening before any of the next major catalysts have even arrived. There's no new ETF approval driving this yet. There's no Federal Reserve pivot yet. There's no change in tax structure, election policy, or digital asset regulation yet. This tightening of supply is happening in the absence of bullish momentum, which tells you that this isn't speculation. It's accumulation. Quiet, steady, structural accumulation. Long-term holders accumulating at this scale while short-term holders are being washed out is one of the most powerful market signals in Bitcoin's history. You can see it clearly in the chodl waves, the on-chain visualization used by analysts like Philip Swift. The bands representing 3-month and 6-month holders are shrinking. The older bands, 1 year, 2 years, 3 years, are expanding. Bitcoin is migrating into the hands of people who don't sell into noise. They sell into mania. And we're nowhere near mania. But maybe the biggest underreported element of all this is the collapse in forced selling. If you go back to the last major capitulation event, the Luna crash in 2022, Bitcoin was under relentless sell pressure. Liquidations, insolvencies, bankruptcies, forced unwindings of leveraged positions, hedge funds collapsing, miners capitulating. This time, however, forced selling is low, very low. Even during last week's aggressive move, we didn't see structural entities breaking. We saw traders get punished, but not institutions, mining companies, ETF providers, or major funds. This is the sort of internal strengthening that precedes supply squeezes. Then we have the geopolitical picture, which is quietly shifting toward Bitcoin in ways most people aren't paying enough attention to. The narrative that governments don't like Bitcoin has already changed. The US is moving toward clearer digital asset regulation. Europe has MyCA. Hong Kong is pushing ahead with ETF growth. And emerging nations like Argentina, El Salvador, UAE, and Turkey are shifting their stance from defensive to opportunistic. Even if you ignore all the political noise, the global direction of travel is obvious. Curiosity has replaced hostility. And this is where the supply shock narrative becomes even more important. Sovereign buying. We're not there yet, but we're not far away. El Salvador is the test case, but it won't be the last. Once one major economy begins accumulating Bitcoin as part of its strategic reserves, the game theory kicks in. You don't want to be the last country to buy. You want to be early. You want to get exposure before the next wave of appreciation hits. Imagine the supply dynamics when sovereign demand begins competing with ETF demand in a market where 88% of the supply is locked up. And we haven't even touched on corporate treasuries yet. Despite the noise around MicroStrategy's recent stock volatility, Michael Saylor's bet still stands as one of the most important institutional case studies in financial history. But what's shocking is that corporations outside the US, particularly in Asia and South America, have begun exploring Bitcoin treasury strategies far faster than Western media is reporting. We're very much in the early innings of corporate adoption, and in every previous cycle, corporations tend to act in the late accumulation phase, right before the breakout. In other words, they buy when supply is already tightening. Now let's talk about something that makes this cycle structurally different from previous ones: custody evolution. 5 years ago, custody was a mess. Institutions didn't trust it. Regulators didn't understand it. Investors feared hacks, failures, and exchange collapses. Today, custody has become one of the strongest parts of the entire digital asset ecosystem. Between Coinbase Custody, Fidelity Digital Assets, BitGo, and the ETF custodians, Bitcoin has become institutional grade, in a way it simply wasn't in 2021 or 2017. This matters because it gives institutions the confidence to hold, not trade. The moment institutions hold instead of trade, liquidity tightens further. Another overlooked but extremely powerful factor is the rise of what analysts are calling invisible accumulation. Custodial platforms, self-custody wallets, cold storage solutions, multi-sig services, and corporate-grade private key systems are all absorbing BTC that never returns to exchanges. When Bitcoin leaves exchange liquidity and enters multi-sig custody for a business, treasury, or trust, it is effectively gone for years, sometimes forever. That's what creates rigidity in supply. And rigidity is what turns small demand shocks into massive price moves. You can't have a flexible supply curve when most of the supply is locked into entities that aren't price sensitive. And that's exactly where Bitcoin is right now. The final part of this section is psychological. Because supply shocks don't just happen mechanically, they happen emotionally. And right now, the emotional behavior we're seeing in the market is far more bullish than price reflects. The fact that Bitcoin refuses to break down during ETF outflows. The fact that every dip is being absorbed by deep pockets. The fact that analysts are identifying early accumulation despite macro uncertainty. All of this points toward a market that is preparing for upside the moment conditions allow it. And when those conditions align, even briefly, people will look back and say, the signs were all there. And when the next catalyst does hit, whether it's a Fed shift, a new ETF approval, clearer regulations, or even just a wave of returning retail interest, the move upward will look stronger and faster than people expect, not because of hype, but because the supply side of the equation is already stressed. That's the real story of Bitcoin right now. Beneath the volatility, beneath the headlines, beneath the fear and the noise, something quiet and structural is forming. Something that takes months to build and seconds to be recognized once price begins to react to it. And when we look back at this period, it will be obvious. This was the part of the cycle where the supply shock started forming, and almost nobody realized it. Thanks for listening, thanks for the support, and as always, drop your thoughts in the comments, follow the show for the next deep dive, and we will see you at the top.